welcome to the weekend's extensive video, which is called S&P 500 Equities. What a great week we with clients had. And this is about the dive into charts. Deep, starting with yields. You can see that the trend of that descent is quite there. And Friday we had seen stocks move only sideways. S&P 500 while yields had moved up. What does it say about the underlying strength of the S&P 500 advance? Examining breadth, we can see that these metrics have quite retreated, and this is, of course, because we are talking about just Friday, following strong ascent on CPI and unemployment claims. We will get to that later on. We can see that retreat in market breadth strength metrics had been most apparent on the short end, meaning stocks trading above the 5-day or 10-day moving averages. There the retreat had been most pronounced. Here we go with S&P 500 hourly chart, which is capturing more than a week, including that stark Friday's drop caused by correct ascent following non-farm payrolls, flush, and when I told clients still on Friday that this is nothing to worry about, that stocks would recover, you can see how clearly they had been grinding higher ever since, and there had been two noticeable bumps on the road, one more concerning than the other, of course. The first one being PPI, which had been presenting stocks with a setback for a good couple of hours, and a very clear celebration and clear rejection of fear following CPI. Because, as said, CPI message had been overshadowed by rising unemployment claims, and even if we have inflation readings not totally there where the Fed would want them to see, the calculation is clear that there would be preference of the dual mandate job market support and not just 25 basis points cut in rates next week, but quite possibly 50 basis points on the table. Personally, I'm leaning towards 25 basis points only, because the inflation reading is still quite there for Powell, given his historical tendency not to underestimate inflation following the transitory debacle. This is where I see the rate cut coming. Compare that to Nasdaq, and we had seen that it had been not too shabby. There had been quite a few good periods, so when Russell 2000 had been clearly outperforming Nasdaq and S&P 500 as well, and the most pronounced one, the call that I had made for clients, had been on Thursday. And back then, Russell 2000 had delivered the best gains, and for Friday I had called for rebalancing of that trade at the expense of IWM, clearly in favor of Nasdaq rotating back into tech, and of course S&P 500 is being saved by distinctly good market breadth readings. Here you can see that what is a little bit misleading when it comes to the strength of interest rate sensitive plays. Real estate is barely up on the week, but Is it totally justified, or are those interest rate sensitive trades slowly getting underway? I suggest that you review Russell 2000 chart versus S&P 500 chart. Do it as a ratio, do it as a IWM chart, whether how close it is towards its latest highs. Do it for a weekly chart, and you will come to your own conclusions just as much by examining various internal stock market ratios. So do yourself a favor, because this is what I'm covering in great detail and talking that whenever that makes sense with clients so that they benefit the most.